Yeah, welcome back, guys. How are you guys doing? Yeah, so basically, I promised you guys that I'll release a video on true liquidity in line with the right timing and this weekend, and that is exactly what this video will be all about. Okay, um, this is a very major video, which we want to explain and help you with inducement. Inducement is a very common concept which most people that trade it don't actually understand. And here you tend to actually understand what in true inducement really looks like. Okay, inducement is actually a place where there is high volatility. When such place is absorbed, and then you expect if price want to reverse totally, you expect a reversal after that. Or if price just want to, raid such area and then pull back, maybe a little or to some extent, you expect that to actually also happen at a place where you actually call true inducement. And true inducement area is actually very simple and basic. It is a direct thing. It is something many people talk about but don't pay attention to. You see, people telling you about this is a very common thing in the industry, whereby people talking about you want to trade when two sessions overlap and the likes like that. Yes, to some extent, that is very correct. And what makes it correct is that where two sessions overlap, okay, is more like two different market makers. There are different participants in each session. So we're through two different participants where they overlap, such that one of them is in loss. And the one in loss has to actually mitigate his loss by what? By maybe increasing his uh by maybe decreasing his offer and then increase a bid, or decrease in offer, increase in bid. What do I mean by that? Let's for example now for exchanges, people that sell Bitcoin, that is that exchange Bitcoin for Naira, that help people with that and the likes. All right. If such person hold too much coins, too much Bitcoin, and the person is now in loss, maybe the coin dropped or something like that, what do you think the person will do? The person will start with decreasing um his offer, that is the sell. So let's say he sells before Bitcoin at the rate of 1,300 to Naira. You see him decreasing his offer to, let's say, 1,200 Naira, so as to attract people towards itself. Same way is the concept of true liquidity, or what is, in the industry, most people now call inducement. The concept of liquidity only comes from which particular high or which particular low is attracting price to itself. What is calling price to itself? By decreasing offer. What is calling price to itself? Decreasing offer and increasing bid. Okay, so what is price? What is calling price to itself? What is that area where there are two different participants, whereby, one of the participants is able to have a mitigation already, make his own money, sell everything that he has at hand, every liquidity he has at hand, and the opposite one overlapping is in loss. All right, is in loss. Therefore, he has to what? He has to expand momentum. That it is a place of volatility. It's a place of volatility. And at the place of volatility, that is where you find an imbalance. Okay, that is where you find an imbalance. So, and what do we say that price seek to repair? We say that price seek to repair an imbalance area. The most common imbalance many people are so used to is FVG and all. No, that is not just imbalance. That basically is what we even call momentum imbalance. All right, in a way whereby there is an aggressive move, that is, the aggressors are limiting the impact. They are limiting the impact of the passive orders. That is, They are limiting the impact of that order block. That is why you will see that there are many order blocks and yet price violating many of them. This does not mean, so that's why when you see tweets like, or when you see posts like, this is how to know valid order block, yes, at times those things make sense, but most times that is not actually true because many other blocks are valid. Many other blocks are valid. This other block is very valid. So sweep liquidity, yeah, there is liquidity before it. Some will say that it leads to break. Oh, of course, it is the one that leads to the break of this low right here. It is the one that leads to it. So it is not another block being valid or not. The question is which liquidity is calling price. If the liquidity that is calling price is above that particular order block that seems so neat, it will be rated. It will be rated. Which liquidity is calling price? It will be rated. You don't have, there is no two-way around it. It will be rated. No matter how nice it is, I can teach you from now to eternity many ways to look at to pick the right order block. It will seem as though it works and works and works, or to pick the right AOI. Generally, I just mark AOI. There is no different AOI for me. It's just one single AOI, one place of dominant buyers or sellers. If you are new to my page, you might want to watch my video on AOI and imbalance to actually know how I pick area of interest generally. Okay, so majorly, it is about what is calling price. As price diverged towards this high, that is it. All right. So that's basically how it is. And that's what we're here to discuss. So I'm here to basically give you guys how to actually be able to be better in terms of picking liquidity. Liquidity simply, when you are picking liquidity, please pick liquidity where there are overlaps. What do I then mean by overlaps of liquidity? Even though there is more to it, based on open range concept, because even though they overlap, they have to diverge against each other. But not to complicate things in quotes, not as if anything is complicated, but based on how I trade, based on my concept, going deeper into market might seem confusing, and I want this video to be for anybody that maybe especially is trading SMC and whatnot. I want it to be useful for you. All right, so that is how I want to make the video. But if I should use my concept, I will tell you exactly 100% how to always mark the right liquidity every single time. But just with this detail I will give you as well, you should be near perfection with it. That is just the truth. All right, so overlap. Let's talk about overlap. So let's say I have a range like this. I have a range like this, and maybe also a range like this. If your bias says that price, so what want to talk about here is liquidity or inducement, or even how to catch small reversal trade. So how you want to use it, based on how well you perfect it after I talk about it, that is now left to you. Okay, so now I have a range. This is a range, a swing move. This is also a swing move, right? The question here is, for major inducement, where does higher volume OR, where do they overlap? For you to have major inducement, higher volume OR, where do they overlap? Now, where do I mean by higher volume opening ranges? That is a previous week, for example, or even a previous month. So here, let's say we have a certain week 1, and the move that came to raid this move that came to raid this is not in that same week. It is another week, say week 2. Okay. When price shifts and price is seeking liquidity, there is a high probability that price will be seeking this particular high because of the overlap. So this is what we mean by overlap. Week 1 and week 2 overlap each other. Don't forget, I said something. They must actually have diverged. That is, this low and this aggressive move that rates it must actually have diverged for it to be accurate. But I don't want to talk about true divergence because that might seem confusing teaching you true divergence, but I want this to be as useful as well. I don't now know if maybe tools like RSI around this range, now that I'm doing this video, that is coming to my mind that maybe to some extent might be accurate for you. All right. For example, to make it beautiful, maybe you see that here, you know, this is a low, then you see this forms a lower low. Maybe at exactly this point, your RSI forms a higher low instead. That could serve as confluence. That will actually be beautiful to serve as confluence for you so that you'll be able to know that they kind of have divergence between them. When you have divergence like that, divergence shows that there is a dominant in one direction. Either it is buyers that are participant in this particular week, which is what my concept shows you, okay? But since we won't be using that, let's just use the normal basic of identification. So either it is buyers participants that are here, and it is sellers that are this particular week low, this particular low here formed from the previous week, okay? Not necessarily the last week low, but a low formed from a previous week and a move that comes to read it from a new week. Even this old move can still be the week 2, can still be the week 2. All right. So where these guys overlap, this is what we call overlapping. So where week 1, week 2 overlap, it can also be month. Maybe April is the one that formed this low, and May coming to now read it. That is an overlapping of month. Those are major liquidity areas that will give you good for. So when price come back, this is what you want to pick as your true inducement or your true liquidity. Okay, this is what you want to pick because there is a high probability that these guys diverge against each other. And I said to even use it as confluence, I will try that. During this video, I will try that. I've never tried that because I know how to pick divergence before even they happen. I know how to spot it. And you've been following my concept, you will understand better. So let's say these guys overlap. All right. This is your liquidity. And when price come to radiate, avoiding volatile times, you know, volatility majorly is what causes imbalance. That is where there is aggressive move that is limiting the impact of passive orders. What are your passive orders? E.g., your order block. So when you see price violating your order block anyhow, that is what? That is an area of imbalance. That is the expectation. Ideal thing you expect to happen is for that order block to be respected, or for that support area to be respected, or for that resistance area to be respected. But now that area is violated. Therefore, that is what the limit of passive order, that is an imbalance. And that only comes through volatility. So during high news, that is why you see that people that don't have deep understanding of market participants, for example, most SMC traders actually, I've been an SMC trader rawly. I've made money with it, so I'm not here to backlash anything. I'm just trying to tell you that the reason why you're advised as an SMC trader to run away from news is usually because that is when there is high volatility, whereby that your fresh order block that you think will be mitigated, that is when it gets to be violated. All right. So except if you know the true participants in the market, all right, if you really understand market's logic, you are able to actually read true order flow in the market, then can you say you want to participate in something like that? But if you can't, then don't try it. Okay, don't try it. So what I'm teaching you now, since I'm not using my concept, I am not finding true participants for you. I'm not teaching you to find true participants or not. I'm just teaching you neutrally that when you see two overlap, then I will advise that you stay away from news when you are trying to apply this, because news can even raid, news can raid as many major liquidity as possible. So when this is rated as inducement, even if you don't know the direction of the market, I'm telling you how powerful this is. Even if you don't know the direction of the market, you see major area like this where two things like this are rated, two overlap of major volume. You know, a weekly volume is higher than daily volume relatively most times. Monthly volume, a volume that is traded for a whole month, then against another new month, overlapping each other. So the high that is formed, or the low, for example, let's say this is month 1, maybe April, and the aggressive move that came to raid it, that came to raid this high, is, let's say, month 2. So which means this low here is the major liquidity area, available liquidity area. So when price raids this, okay, and you now see maybe during your trading session, London, New York, and you now see a true break of structure or something, trust me, this is a good place to look for sell, at least for a nice maybe 1 to 3 trade. Okay, and where will even be your target? Your target also should be maybe places of lesser volume overlap. For example, let's say what form this is sessional. Let's say this was Asia session, and the aggressive move that came to raid this is London session. You can quickly target this because price move to places of least liquidity relative to demand. When we say price move to the place of least liquidity relative to demand, it simply means when major liquidity like weekly, where weekly volume meets, where both of them meet, when such volume is absorbed, that is a much higher liquidity compared to volume traded in Asia and London combined, right? So this is an easy target. This is a very interesting model that follows true market logic. That follows what? True market logic. So you can easily take your profit around there, or even if it is around there, maybe New York and London, targeting lesser liquidity area, that is where 2 sessions that are much lower in volume being traded compared to what? Compared to weekly overlap areas. So where 2 sessions overlap, where 2 days overlap, maybe day 1 also, a certain day 1, maybe Tuesday, and Wednesday coming to raid the high of this, therefore making these available as maybe major inducement area. So price move from level of liquidity, absorbing liquidity, to reverse to another place of liquidity for its continuation or for complete reversal. So this right here is how to look at true inducement. It is how to look at true inducement. So check. Use your, for example, this is what is it called now? For example, this is daily volume. For example, look at this. Look at this. You would see this was the trade I took on Twitter. If you're following, I took this trade last week on Thursday. All right, I took this particular trade on Thursday last week, right here, and then my final target was there. Let's look at that, for example. All right, let's look at the futures chart, because here did not really show us what's happened. I just want to explain it. There is more to how I trade, of course. For people following me, you understand there is a lot more, but I just want to use this to help the community so that you will understand where to actually look for liquidity. Liquidity should be where you have overlapping of session, of days, and all that. Go back to your charts now, go and regather your data based on this video I'm teaching you, and come back if that is true or not. So look at this. This is day separator. My indicator is that I used to separate the day and week. These thick broken lines separate the week, while these separate the days. These thin ones, they are day separator. So majorly here now, this is Thursday or from the previous week, and this is Friday. So look at this here. Look at this here. So look at this here. What did you notice? This particular low was formed from the previous day. Now, a new day opened, and the new day that opened is the one that came to raid this. So this was Thursday, and the aggressor that came to raid it Thursday is now passive. The aggressor that came to raid it, this is Friday. So that is where they overlap. So we have a swing move, a pullback from Thursday, and then Friday came in, a new day open, Friday reached that particular high. Hence, this low here becomes the available liquidity as inducement. at least to watch for reaction. So it is below liquidity like this that you want to start looking for order block, as you see me marking. You see me marking my area of interest here, that is bearish candle among bullish candles. As you see me marking, it is below those areas that you want to start looking for valid area of interest. If there is no engineered liquidity like that, so if there's anything like true engineered liquidity, it is where you have overlapping of days. Don't forget overlapping of session. And where is my target as well? Where 2 days again overlap. Where 2 days again over what? Overlap. Look at it. So look at it here. You have price cleared the low here. Is that understood? Now, from here, we have this low from Monday, and then we now have what? This move here coming to raid it on Tuesday. That is overlapping of volume. So, and what is available? The high the bull created is also available when it is time. Now, look at here. Here, this particular one, the target here was a lower target, that is a lower overlap target, that is sessional overlap. That is where I targeted. I did not target the daily because daily volume here, okay, this is daily volume. Daily volume is what was absorbed here. What formed this liquidity here was 2 different days, Thursday and Friday. This rates this, create a high by Thursday. The Thursday also creates a low, okay? And then Friday is the one that came to raid the high from Thursday. Then the low, they both create that effect, the low that arrange both of them as marked during the schematic. That is, I have something like this. Sorry. So I have something like this. So this is Thursday's high. This is also Thursday's low. Friday came and rates Thursday's high. This is where they overlap at this range. So this range that overlaps them from this high to this low, the low of that range is the liquidity. It is the inducement. Same thing for sectional overlap. All right. So here in particular, we have sectional overlap. We have what? We have London, which was my final target. So we have London. Sorry, we have New York. New York opens by 1 p.m. So New York opens here. But what formed this low right here is from London. It's from Frankfurt, 7:15, 7:30. So this is Frankfurt session, low. Now, then price came and price came to raid it. Now, what came to raid it is still, this is 7 p.m. This is still New York. So Frankfurt, New York overlap. Frankfurt, and then we have New York overlap. And what happens? The high is available. But like I said, it is not every time that is true. Not every time, please. Very, very important thing to note. But based on the understanding of price moving from places of price moving towards places of least liquidity, you would agree with me that this is sessional volume overlapping each other. The overlapping of them is what creates this high. Finally, this is a swing move. The low being made by Frankfurt, pull back. London is what came to raid it. This is where they overlap. And then the high, which is what? Which gives birth to both of them, is the available liquidity, according to the schematic I drew at the beginning. So why is that a common sense based on the fact how markets move? Is that price move to place of least liquidity relative to demand. Sessional overlap volume is relatively assumed to be lower most times than daily overlap because the liquidity absorbed here is assumed to be a higher liquidity. Why? Because this was 2 days volume. Day 1, forming this high of the day, Thursday. Friday came, rates this high that was formed in Thursday. That is 2 different days overlapping. And this is the liquidity they provide. Price came to induce that liquidity. Where will be your targets? Where 2 sessions overlaps? All right, far beyond. But like I said, the best way to know it is through divergence. Now, let us test divergence. Let us see if here, when Friday raise this high. Let us see if they diverge using RSI. The way I tweet divergence is very different, very, very different. I know it before it happens, all right? And I've taught it here absolutely for free for those that have been paying attention. But let's just say, I just want to check. I don't know. I sincerely don't know. But I just feel it would be a beautiful confluence if peradventure something like RSI around that same point actually overlap for you guys. So I don't know why that is not coming up. All right. So relative strength index. Okay, so between exactly this range, I doubt, I really don't know. I don't know if that would be so. So let me see. So between this and this, yes, they diverge. Funny enough, they diverge. All right. So here now, price rate is high. So this is the point. Let me mark that so that it can be very clear. Pay attention very well. What I'm teaching here is very simple and direct. So, and this is the aggressor move that read it. Ah, beautiful. You would see that here we have aggressive move rate doing it. This is higher high. That exact point, what do you see it forming on RSI? They form a lower high. Higher high, that is what is forming. If they do not if they really did not diverge, RSI also ought to form higher high there. But what did you see higher RSI forming? A lower high. So it's very possible RSI might be giving you that divergence as a confluence, and that will make it more beautiful. And everything I'm saying, that will make it perfect for you to actually what's it called? To actually build. Is that understood? That will make it so perfect for you guys to actually build. But I don't think that will be so consistent. But you could make it a confluence. Maybe where you see them overlapping, check if there is divergence there. That should be make it a good confluence for you to actually know if you should look for a trade around there or not. So that's basically it. So all you need to do is based on your confirmation. I don't know if you find how you find your confirmation or something. And I think RSI even gave you guys a confirmation here, price from a lower low here after reading that major liquidity. And here at exactly that point, price from the higher low, a higher low. Yes, higher low. In fact, this was a sharp divergence. This is the low. This is where the low confluence, a higher low. I don't use RSI, but it's a good confluence, at least as an SMC trader that you may be, or even a normal support and resistance trader. This could help you, okay? This could help you a lot. So you see that such confirmation to actually take the trade, even though that's not what I look at. So to round it all off, the major thing here that I'm explaining to you guys is where do you have your overlaps? Where do you have your overlaps? Where do you have them? That is where you have your liquidity. Where do you have your sessional overlap? Where do you have your this overlap or your closing range overlap, which is the last part I will talk about. Now, when it comes to the sessions, first time converter. So when it comes to sessions, when it comes to sessions, okay. Let me reload this. First time converter. Okay, so when it comes to these, you can always use this website. I don't know why this is not open. I don't know why that is not open. But that's, and this video is already getting too long that I want. Okay, maybe, okay. Oh, it has opened. All right, so just change this to your local time, Africa, Lagos. And if you are in another place, okay. Now look at sessions. When it comes to session overlap, the opening of sessions overlap It's a very common thing, but people don't talk about the closing. So I feel I should talk about that so that you can also look into that when you are picking the right liquidity where there is overlap of timing. Okay. Now look at this. Frankfurt opens presently by 7 a.m., closes by 3 p.m., blah, blah, blah. Now look at all of this. You would see that Sydney, when Sydney closed 7 a.m., that is exactly where Frankfurt opens. So that is why it is not something to talk much about. Where Tokyo closes, when it closes, 8 a.m., that is when London opens, 8 a.m., nothing to talk about. But look at this. When Frankfurt closes 3 p.m., there is no other thing overlapping with it. That means there is a closing range. Immediately, Frankfurt withdraw their participants by 3 p.m. Nigeria time presently, which is when Frankfurt closes presently until November, when there will be change in daylight saving again. Immediately, they withdraw their participants. A whole new entire participant is now working based on knowing, identifying true participant. Same thing in London. When London closes, I know ICT even teaches something like London close Q zone. Yes, the reason why those times are important is what I'm telling you. It speaks about those things, but not in the exact format of how I believe it is to be used. Okay. Closing ranges is the withdrawal of some participants which has overlapped and has been showing us some dominant, which means some new dominants will come. So let's say when London opens, and overlaps with when New York opens and overlaps with London, the new dominant participant, let's say they are sellers in that area. But when Frankfurt comes and Frankfurt withdraws, there will be lesser effects from maybe sellers, or it depends on who are in Frankfurt. For example, if buyers were in Frankfurt, when Frankfurt opens, if buyers has been the participant in Frankfurt Ultra, now they are withdrawing by 3 p.m., which means that will even increase more the effect of the sellers if sellers are in London. But let's say sellers are in Frankfurt, and now sellers are also in New York. When Frankfurt closes and they withdraw their participant, there will be lesser effect. All of these, I cannot teach all of this at once. So I just want you to pay attention to the overlapping of timing. I've spoken about overlapping of days. Those are straightforward. The one overlapping with day two, marking the liquidity at the low or at the high, we understand that. But when it comes to session also, Frankfurt forms a certain low, London, just like the example I've used earlier. But also, we have closing range overlap because there are new participants because of withdrawal of participant. At that point in time, Frankfurt closes a participant. The reason why we don't take reference to that for something like Sydney and Tokyo close is because automatically that's when fresh new participants are coming in. That is, London is opening at Tokyo close, and Frankfurt is opening at Sydney close. Okay, but when we now have overlap, same thing with New York. New York closes by 9 p.m. There is no overlap of session around that time. No new session is open. That is something to note as well. A withdrawal in market showing you there is a withdrawal, and then the closing range participants has to be known as well. Okay, but that is by the side. The major thing I want to point out here is 3 p.m., 4 p.m. especially, that is a closing time overlap. All right, that is a closing range overlap. Okay, and if that closing range diverge against each other, that place will create liquidity. It will create liquidity. It will, because a new form of liquidity injection is there. So it will create liquidity for price to actually come in to take. So what do I mean in essence? That is, areas where you also spot something like this. If you are using Nigeria, you remember that it's Nigeria time that I'm using. So let's say, for example, this is even formed. Let's even say this is formed from New York, maybe around 1:15 p.m. Nigeria time. And the swing move that came to read it is from 3 p.m. above. Trust me, new participants are in place around that 3 p.m. that came to read it. Hence, this high would be available as our inducement or as our true liquidity area. That high would be available if they diverge, if this move, the aggressor and the passive, this low, if they diverge against each other. Okay, so it is very important to know that as well. It could be 3 p.m. and 4 p.m. That is 3 p.m. could form this. 4 p.m. aggressor could come to read this, and then we have that. Okay, so I just feel I should mention that. Maybe in the future, I'll keep talking more and more about all these things. They are very simple. It's just, in-depth understanding of timing, because timing is important. That is what is on your x-axis. The only mistake most people make is thinking timing is time frame. You are taking time frame as timing. That is where it is funny. That's where it is funny. It is not, it doesn't work that way. You are taking time frame as timing. What do you find on your x-axis? Is it time frame? No. Timing is an event, date, and what is happening inside each day, inside each week. That is timing. The event on there, that is what you find on your x-axis, on your constant axis, not this. These are not relevant. That's why you have TradingView having many of them. Did you see TradingView bringing a certain new month to insert here or jumping a certain month? No, it is not possible. But yeah, you see that even if you have premium TradingView and you search 2 day, 3 day, you will still find it, because that is not timing. You are looking at timing from a different perspective, from a very wrong perspective, all right? So that is it. So look at this, for example, before this move got raided. So look at this. This low here is formed from 11:45 a.m. London open. Now, the aggressor that came to raid it is 1:30. That is New York. So we have London and we have New York. Okay, overlapping. What happens? They are pulled back. The high that makes them is your liquidity for inducement. Is your liquidity. Let's check here as well. Let's check here. Look at here. 7:45 is still within the range of Frankfurt open. This next candle is 8 a.m. This is London. So this low here is from Frankfurt. This aggressor that reached that low, this move here, is from London. The high that binds both of them, that is the high of the range that binds both of them, is your inducement. And at every major inducement like that, what you will find is a reversal. Price read it a little and reversed this dip. All right. So that is why I said using this will help you a lot to be able to pick through liquidity. Oh, need I tell you, even here, same thing. But let's go to here. All right. Let's go here. What do we have here? 2 days overlapping. Day one, a certain day, Thursday. Friday is the aggressor that came to raid it, where both of them overlap. And then you have this, and then it's done. This particular one was session overlap. It was session overlap. Here, the high price came to raid there. You can go and check it. All right. It was timing, session overlap. Go and check it here. You will understand. Same thing with news overlap and whatnot. With a session, a news overlapping with a session and whatnot. But that is not my business of the day. This day, Thursday, Friday. The pullback from Friday is the one that came to raid it. The pullback from the Thursday, serving as the major liquidity price is seeking before the raid. Note, I told you, they must have diverged against each other. But most times they do diverge. That's why I could teach it as a straight thing like this. If I want to go in depth, I have to start talking about who are the participants here. Do we have buyers here? Do we have sellers here? Because here, the daily, I think this was finally the participants here was D plus, that is buyer dominant, and here was sellers dominant something, and they diverge. But they must have diverged, trust me. If they don't diverge, price will not seek it as liquidity. In that case, it will be seeked as, maybe true break of structure, or price might not even reverse at all. It is very important, but that is as we proceed. These things are slow slowly. So let's just deal with the business of the day. Timing, overlap, overlap, overlap. Okay, so that is basically everything there is. Let's look at weekly overlap as well. Okay, let's look at weekly overlap. All right, so let's look at weekly overlap. Here, for example, look at it. This is from the previous week. This low is from the previous week, week one. Week one. Though they must have diverged because this particular week was W plus. I've used this to explain concepts before many times. And what came to read it was W minus, that is seller's dominant. The previous week was buyer's dominant, so and whatnot. So, but let's just forget that for now. Here we have week one. Week two came to read it, the aggressors. Week two. What do you see? The high linking both of them is the available liquidity. Price came to read it, and then full absorption, price went down. All right, same thing here. Previous week, low, a new week, week two, week one, overlap, inducement. All right, like that. Day one, day two race, inducement. Day one, because you might be thinking, oh, but that's not the final liquidity. Check very well. Check very well to this. Look at this. This is weekly volume overlap, apart from even the daily ones. Look at it. Previous week, low from previous week. Aggressor from new week, reading it. The high, they both create to that effect as inducement for major move to the downside. So that's why it is called major inducement. That's why it is called that. So where you have high volume over like weekly, monthly, where they overlap each other. For example, look, imagine price coming here. So here, for example, look at this. There's even no imagination in this case here. Look at this particular one. Here, okay, yes. Look at this, okay. Oh, I did not talk about flipping. Don't worry, this is still same month. Don't worry about that. But different participants that are this low, even though we are within the same month, different participants here, they flip here. Buyers took over. Buyers participants are the one that came to read this. So, but don't worry about that. So it can be monthly overlap. It can be anything as major inducement. So all you need to do, based on how you will trade, is when you see internal range liquidity, when you want to mark your internal range liquidity, that is where you want to look for. That is, you want to mark liquidity around this range that price should be seeking, maybe even to the extreme. So you want to go for where maybe daily overlap or sessions overlap, or where the 2 weeks overlap, like that, okay? So, and that will be all for this video. This video is already too long. I will see you guys, maybe part 2 of it, do more examples, and also talk more about participants, because I did not talk about participants here. But this should be very, very helpful to a lot of you. So don't forget to share with friends, and I will see you guys in the next one.